Hi there, this is Hania, and the purpose of this video is to talk about the different types of credit that we have available and the purpose of each one. Really, the reason I wanted to start to talk about the credit, it's as my first video and not the different account types that we have, is because I believe that the way we manage our credit has a bigger effect and consequence than the way we manage our accounts. You see, before we used to pre-evaluate a person judging on what their background is, or what school they went to, what job they held, etc. And now, when a bank wants to evaluate you, or even a cable company or insurance company, they check your credit bureau, which basically gives them an idea about how it manages, how we manage our credit. So let's start with the basic. The easiest one would be an overdraft protection. So it's a credit that's directly linked to our account. It could vary usually between $250 to $1,500. There's fees related to that. Depending on the institution, it could be by usage, meaning when the time you use it, you'll pay a fee. Normally it's around $4 or $5. Or some banks just will charge you every month. It could be again $4 or $5. Now the interest rate is between 19 to 22% on an annual basis. So what happened with that is that let's say you don't have any money in your account for now, and your next deposit, I don't know, let's say it's in 3 days, but you made a check that has to pass today. So the account will be withdrawn from that account. Let's say it's for $100, and when your paycheck will be deposited, let's say in 3 days, it will simply just cover the $100. So we have zero in your account, we go to minus 100, and let's say you have a deposit of $500 3 days after, so your account will be minus 100 plus 5, so you're at $400. Now, how much did those 3 days cost you? They cost you the fees, which are $5, and they cost you, if you have a 20% interest with your bank, $20 is roughly 5 cents and a half a day, so it costs you like 16.5 cents for those 3 days. So really, this is just to give you an idea about how it works. The bad thing about the overdraft protection is that it is expensive, and it's really you're really supposed to use it extremely occasionally. It's a type of insurance, if you like, so you should not count on it to use it as a money that you have. So as an insurance way of looking at it, I personally think it's worth it. And the advantage of it is that it's paid off really very easily with the next deposit in your account. It just covers it. Now, again, this is money that you don't have. It's a credit that the bank is allowing you to have, and it's not something that you should count on every month or like on a weekly basis or on a monthly basis. So that's for the overdraft protection. Now, second type of credits would be the line of credit. The line of credit is different from your account. Some banks will allow you to link them together. So when there's not enough money in your account, it will withdraw automatically from the line of credit. But for some banks, it's completely different accounts. You cannot link them together. So the line of credit, it could go between $1,500 to tens of thousands of dollars, depending on your situation and depending on how much your bank will allow you to have as a credit. the interest rate on it as a personal line of credit, it's usually around 7%. It could go from 5 to a higher interest rate, again, depending on your situation. And so the way it works is that the minimum payment that you have to make on it on a monthly basis usually is only the interest. So, which is very flexible. You can pay it on the on your rhythm if you want. But again, this is money that you don't have. So whenever you have an extra dollars or whatever, just pay it on. And the interest is calculated per day on it. So the good thing about the line of credit, it's the flexibility. You know that it's always there, and the flexibility of payment. You can either pay the interest a little bit more than the interest, the whole amount. So it's extremely flexible in that way, and you still have the money available. So let's say you have a $5,000 line of credit, you used $2,000 on it, you paid it back. So it means you still have available again the $5,000 without having to go through again another application with a bank. So the flexibility is extremely helpful. Now the other side on it is if you're slightly not disciplined, I mean you would always go back to the line of credit to whatever purchases that you have. So for that you have to be careful really for the line of credit. Now, the other type of credit that we have is a personal loan. The personal loan is a very straightforward type of credit. You take a certain amount um, of, of loan, of money from the bank, and it gives it to you, and you have to pay it back with certain length of time. So you can say that you want to pay it off in a term of 1 year, 2 years, 5 years, whatever your agreement is with the bank. And with that, also the bank will tell you what the interest rate that you have on that loan. So let's say you take a loan for 3 years, there is no surprises. You know that it's going to end up in 3 years. You know what every month you have to pay, or every 2 weeks, or whatever agreement again you had to pay, and what's the amount you have to pay, and you know what your interest rate is on it. So basically, there is no surprises with that type of loan. We know when it starts and what it ends. So in a way, it's a good way to have a credit. Now, the other side of the coin is that let's say 1 month you're unable to pay the loan, you have to go and ask an authorization from the bank to see what arrangements you can make with them. So you're really on the bank's mercy at this point if it's going to work out or not. Usually they are understanding, but again, you have to check with the bank for that. Now, another type of credit, and it's probably the one that I would say that it's a must in this day and age, is a credit card. The reason I'm saying it's a must is because a lot of purchases of even services that we need to have depend on having or not a credit card. Whether you want to buy on internet, whether you want to rent a car, or whether you want to reserve a hotel or a flight. So you do need a credit card in those situations. So the way you have to look on a credit card is to check what's the interest rate that you're given for that card. Usually it's around 19%, but be careful, it could go up to 29%, especially the store type of credit cards. So, and also you have to check for the rewards, the points reward that the credit cards are giving you. So what is good with the credit card, if you know how to use it, is to take advantages of those rewards and not to pay the interest. And basically you don't pay any interest if you're paying the whole amount before the due date. So that would be the best way to use the credit card. So you will have the reward points and you don't pay any interest. Now, if you are someone who's you use a card and will not be able to pay it off every month before the due date, you better check for credit cards with the lowest interest rate. So the rewards are really not important at that point, or they're not really that important. You're better off trying to find a credit card with a lower interest rate. So that's, I think we covered mostly for the credit cards. I would suggest, if you have a minimum of discipline, try to get a credit card as soon as possible. So you start to build your credit bureau also. That we'll be discussing probably in the next video. So that is for the credit cards. Now the other type of credit is the mortgage. What a mortgage is a big loan in which the bank takes your house or any real estate basically as a collateral. So usually the interest rate, not usually, the interest rate are lower. So to give you an example, right now we're in March 2015, almost April 2015. The interest rate in Canada for a mortgage for 5 years, you can get for a 5-year term 3% interest rate, which is historically it's just a great rate, interest rate. So basically the way it works for the mortgage, because it's a big amount, classically you take an amortization for 25 years, which means that the whole mortgage should be paid off within 25 years. Some people take it shorter, like 20 years or 15 years or 10 years. Or for some conditions, you can go to a longer amortization. That again, you have to check with the bank at this point. So in that amortization of 25 years, let's say, you can choose with the bank to take a term. It could be 1 year, 2 years, or the classic one would be 5 years. Especially this is what I would recommend for the first home buyers. So if you take a term, let's say for 5 years, you sign a contract with the bank that this would be the conditions for those 5 years. The conditions meaning you'll be paying monthly or bi-weekly or weekly, and that would be the interest rate. Now, after this term, you would negotiate with the bank for the next term, and so on until the 25 years are over. So after the 5 years, actually you're a free agent in a way. You can either decide to renegotiate with the bank, or also you can look around and see what other institutions are offering. And then again, you will see if you take it for another 5 years, for 3 years, for 10 years, depending on your situation, and especially on the market situation, what would be the best option for you at that point. Maybe the interest rate will be higher. Now, the chances are that in 5 years, let's say from 2015, the interest rate would be higher. Of course, nobody knows for sure, but the interest rates right now are extremely advantageous for buyers. So basically, that's it for the mortgages. We can also look into have a home equity line of credit. It's like a personal line of credit, but the home equity line of credit, again, we take the house as a collateral. So the line of credit amount is very important. Usually we can go up to 80% of the value of the house. So let's say your house is valued as 200,000, you can go up to 160,000 as in a line of credit. Again, the advantages of that is the flexibility of it all. It's you don't have, let's say you buy the house, you're paying it off, you need to do some renovation, which usually when you own a house, you have to calculate a certain amount for that. So you don't have to go back to the bank to ask for another type of credit. You can use your own line of credit on it. Again, you have to have a certain discipline on it, otherwise it will go out of control. But it's a great option also to work with a line of credit, especially that the interest rates are very low. Again, to give you an idea, right now the interest rate should be around 2.5. you can get 2.15, sorry, 3.5, so you can get 3.15, even lower. With some bank, you have to negotiate and check around, or a little bit higher also. But I would say on average it should be around 3.5 for the interest rate for a line of credit. Now, those are the classical one. There's only one that I'm leaving for the end. It's the consolidated loan or the consolidated credit, in which you take your, let's say you have too many credits, and sometimes just to manage all of them, it's getting overwhelming. So you can see with the bank if you can consolidate, let's say, one credit card, one line of credit, one loan into one consolidated loan, in which you know that it will be paid off in, let's say, 4 years or 5 years. The interest rate usually is a little bit higher than a personal loan. It's around 13-14%, but at least you will know that when you make those monthly payments or those bi-weekly payments, the loan will end after whatever term you decided with the bank. So I think we looked on the basics of the credit. Please, if you have any questions, don't hesitate to write or to let me know, and I will answer you with the information. So thank you very much. Have a good day.